Factoring is a form of asset-based lending. Short-term assets on a balance sheet may be a candidate for factoring. It accelerates cash flow or provides immediate relief. Companies sell their short-term assets at a discount to factoring firms such as thriving companies, startups, negative sales trends, or even bankruptcy candidates. The factoring firms charge a fee for the assumed risk. It's important to remember that factoring is not considered a loan. Factoring is a process where a company pays you upfront for your invoices at a discount, so you're getting paid for what is already owed to you. Here are some of the industries covered by factoring: manufacturing, staffing, food services, contracting, medical, wholesale, professional services, construction, subscription companies, trucking, cleaning, and retail. There are three key players in the factoring workflow: the lender, the client or the borrower, and the customer of the client's company. We'll simply call them customers. It starts with the services performed by the client. The client then sends an invoice to the customer to be paid at a certain date. In the event the client needs funds while waiting for the unpaid invoices, they can request an advance in the form of factoring. The lender will do their due diligence on the client's invoice. After evaluation and the lender decides to fund the request, the funds will then be provided. The lender will take the company's invoice and will then receive the customer's payment directly instead of it going to the client's company as it normally would. In some cases, if the lender is not comfortable with something they see on an aging report in regards to how your client's customers have performed historically, they may elect to withhold some of the balance until they have been going to recoup the initial advance. For example, if the lender purchases $1 million in invoices, but they do not feel comfortable giving the full advance upfront, they may provide an advance of $500,000, and then when they have recouped a portion of that amount, they will release the remaining balance minus any fees the lender needs to collect. The key elements in a factoring deal are quality aging reports and the quality of your client's customers. Sometimes, management experience, reliable sources for the supply chain, and verifiable payment also contribute to the strength of the deal. Factoring can be a great facility in your toolbox to be proactive with your clients rather than waiting for them to come to you for debt. Let's take a look at Emmy's Clothing Distribution Company as an example to show the impact an injection of capital can have on a business's profit margin. You will see that even an organization that is thriving and may not need debt can still benefit from an injection of capital. In this scenario, you will see that we double their capacity to purchase their cost of goods. Even with a factoring fee becoming a part of their costs, you will see that their profit margin increases. In Amy's current financial scenario, she spends $325,000 in order to generate $500,000 in gross revenue. After including her fixed expenses, she has a profit margin of 15%. She then decided to expand her business and utilize factoring to get an injection of cash large enough to double her purchasing power. So because she can now purchase $650,000 in cost of goods, she will be able to generate roughly 2 times the revenue. She will still have her fixed expenses, but will now also pay a factoring fee of 2.75% or $27,500. Even with the fee for factoring, she increased her profit margin by 7.25% due to her newfound buying power. Take some time to think about how you could position yourself with referral partners or internal financial leaders to a business to show how capital can impact their bottom line. Many brokers will wait until a business needs a loan. However, a great broker will go out and find clients that are thriving and show them how capital can make them even more successful. Can you spot one of the primary benefits in this scenario? Hopefully, you know now that this would be an injection of cash and therefore would sit as an asset on the balance sheet rather than sitting as a liability on a balance sheet. Any financial executive, CPA, or anyone with a fiduciary responsibility to their clients will understand the importance of protecting a balance sheet and strengthening the asset column. Factoring is one of your quick close facilities. The average commission for factoring is 1 to 5 points and 5 to 15 points residual with an average life cycle of 18 months.